down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
All right, Savvy investors, I'm pretty excited. First of all, I like to interview celebrities. Now, some people think celebrities is with stature. Yes, celebrities is also with funding. If you're usually a celebrity, you can loan people money. So in my world, you are a celebrity. And the reason why I call this guy a celebrity, because he has done over 500 loans, 65 million. Let's sink that in. $65 million in transactions, 500 loans to little itty bitty people like me, real estate investors. Please welcome Scott McLean, a real estate investor himself. Funding is in his blood, and I really appreciate taking the time to come out here.
You bet, man. Thanks for having me.
I'm excited. First of all, let's just get this out there. So I have never borrowed hard money, which a lot of people, I just want to get this straight out the gate, that hard money is not a negative thing. A lot of young investors, that they're always concerned about the interest rate. 14. There's people out there doing 18. Yeah, and if you can acquire an asset with little, there's cost. Obviously, we're going to talk about due diligence. But with some effort, and you can close a deal in maybe only 3 to 6 months or a year, you acquired a free asset. And it's usually, when you have something in your name, it's really not hard to refinance something. So people, they're worried about the 14%. And I was one of those people. I used to think that you were a shark in the waters.
Right.
But I was uneducated. And that's what this episode is. I want people to know about private money. What is it? How does it work? The good, the bad, the ugly, be whatever. Be honest as possible, authentic. But before we get into that, so how in the world how'd you get here? Anyway, this is Scott McLean. If I didn't say it, Red Dirt Lending, hard money lender. Right. A lot of my friends use you. I see a lot of portfolios where 10 or 15 of your name on there. Yeah. Well, not you, but but your company. Mm-hmm. And I've seen you've changed. I've seen you've adapt with. I studied you before the Dodd-Frank because I have a passion to loan people money as well. Mm-hmm. I want to get to that point. And I've seen that you've adjusted, like right on your website one time, you have to have an LLC. That's right. Before you even call me. Don't even call me. That's right. And also fill out this application and throw me some cash too. Yeah. A friend of mine's getting some hard money, and I don't want to say his name. You know him. He charges $50 just to get in the car to drive over there.
I love it.
And but people are like, oh no, there's a thing called time. How many loans go through your desk that they're just not deals. Yeah. And I was helping an investor yesterday. There's no margin in here. Right. Unless you have cash. Yeah. And it's not a deal. That's so. Right. Tell us a little bit about you. Who are you?
So my name is Scott McLean, and my dad was R.T. McLean, and with him and my two brothers, we were in a family company called the Mole Corporation, and we were commercial real estate investors for a long time.
Here in OKC?
In Oklahoma City, back since like the 70s. So been a long time with that. And then we started buying houses in 2003, and under the Home Investors We Buy Ugly Houses thing. And then a few years later, I became dissatisfied with that model, frankly, and family businesses being what they are. Mm-hmm. A lot of chiefs, not enough Indians. And so I decided to branch out and start Red Dirt Lending, which is hard money lending. It was a fellow franchisee out of Houston who was doing hard money lending, and I cozied up to him and basically copied his model.
Cool.
And that was February of 2007. So next spring, we'll celebrate our 10th anniversary.
Okay, so now a lot of people don't know this, but your brothers, your family, loaned money as well. Were you the first one that started loaning money?
Yes.
Interesting. Yeah. And now you guys are in Dallas market.
So
what markets are you in now?
I started in 2007 in Oklahoma City, of course, and then quickly we started lending in Tulsa as well, because the same dynamic really. And then later in 2008, I decided to grow the company again. And at the time, if you'll recall, the coasts were having massive problems, and they weren't a candidate. So we ended up, I screened several cities and ended up with Minneapolis, St. Paul. So I started flying up there once a month and just really got lucky because as it turned out, the timing was great because literally the month that we made our first loan was the bottom of that market. And all the old hard money guys up there were nursing their inventories. Yet I was able to come in and, basically just do what I said I would do and capture market share. So over 70% of our lending business has been on homes in Minneapolis, St. Paul over the last 10 years. Yeah, it was a great move.
And you're still active up there too?
Yeah.
And you guys are in Chicago as well?
So then my brother Rich started. Okay, so then...
clarify that, because I had a friend call me in McLean's. Do you know I was confused on your name.
Yeah.
And they're like...
It's the Scottish Mafia.
Yeah. You guys loan money in Chicago too. I'm like, this is a small little house on the corner of Classett and 50th.
That's right. Yeah.
Like, how are they this aggressive?
Yeah.
Like market share.
So after seeing me start Red Dirt and having success, another brother started in Denver, and then Rich, the one that you found out about me from, started in Dallas. He had a little trouble getting traction there. There's a lot of competition there, actually. And then he went to Chicago, and Chicago's just enormous, and he's doing quite well there.
Good. And do they live there, or they live in those
No, we
markets?
all live here, and then just, take
every
trips
once in a while. Wow,
up
excellent.
there 3 or 4 days at a time.
All right, so where are you getting this funding from? I know you're not having a print machine in the back room.
Right.
I understand a lot of people don't know about banking, so we got to be slow.
Mm-hmm.
There's a thing called the Fed. They borrow money, and then they turn around and loan it to you, or they loan it from their deposits.
Mm-hmm.
Now, I mean, you're not a banking institution, so where are you getting your funding, and how does that work?
Right. Initially, we were fortunate. My dad funded initially to get started. We talked him into it and did a few loans, and then it worked out. And he said, okay, this is cool. And so he loaned us a little bit more, maybe up to $500,000. And then we decided, okay, this is working, so we'll take it to the bank. And we've since turned that into about a $7 million loan with the local bank. Nice. And then I've also done a private placement memorandum where I've raised $2 or $3 million more from just friends, family, people who know what I'm doing, that kind of thing.
Cool.
So several sources of funds, but I'm also looking at another bank because you never want to be with just one bank, because if they wake up and decide they don't like you, you're out of business.
Or they don't understand. I think you have a unique business model.
That's true. That's
true. Because they may feel competition, but it's really not, because you're servicing a totally untapped market.
Right.
Yeah. And it's not regulated.
It's not regulated.
Which is what I like. But
it's highly fragmented. It's comprised of a lot of mom and pop operations. Our operation would be considered more organized and higher volume than most. But a vast majority is just wealthy people, who give Cousin Eddie $100,000 to go flip this house, and then he brings it back and pays him whatever he pays him and keeps the difference. That's where most of the money comes from, is individuals.
Right. So what's the process and hard money, and how does it work? Like, I'm a real estate. Is it mainly flips? Do you do holds at all for people?
No, it doesn't make the rates are high, so it doesn't make sense.
Like what is the rate right now?
So 14.5 annualized, and then you've got 4 points, and it's a 6-month loan. So it doesn't make a lot of sense unless you're a landlord investor who just needs money to bridge a deal to roll us out with permanent financing. Then it makes sense. But most of 90+% of our customers are flippers.
Now, to me, I'm a buy and hold guy. I'm not a big fan. I flipped a few properties in my lifetime, done some well, done some very bad, very diarrhea moments. I'm assuming you have defaults. I mean,
yeah.
So how do you handle that deal? How does that, okay, first of all, what due diligence? Let's start there. How do you qualify this individual?
So we're looking for two things primarily. One is your experience level. Do you know what you're doing? And or do you have a team of people together to get the job done? The second piece is how deeply you're buying the property. If you're buying the property cheaply enough, sometimes even if you don't know a lot about what you're doing, you can still make money. And we're obviously looking for the security that for us.
The collateral.
So if you're buying it cheaply enough, there's a very, very good chance you're going to make money.
Right. Is there percentages like it's ARV 100,000? Yeah. Let's just give us some examples. Like,
sure.
What's a bread and butter deal? Like, I call you. I mean, I know you. You drive to every house now.
That's true.
Your team.
Yeah.
Because I know you know neighborhoods. All right.
Yep.
So let's just say it's a northwest side house. Let's say it's off of Classen.
Yep.
And you just know it's worth. Let's just play. What's 100,000?
Sure.
What? Give me a bread and butter. What? Like you don't have to think about it.
Okay, so yeah, after repaired value is $100,000. It needs $20,000 worth of work, so we would call that an $80,000 as-is house.
Okay.
We will loan a maximum of 70% of that amount,
Of
which
the
is
80.
of the 80. So that's going to be $56,000. So our investors are going to be out there trying to buy in the 48 to 52 range, something like that, and we're ready to go. We roll in the points, so you don't have to come up with that. And we're a little different than other lenders in that as your skin in the game, we have you prepay the 6 months of interest. Okay, so on that $56,000 loan, I don't want to confuse that. Sorry. So
And this is at closing. Like
yeah.
So I'd have to show up with 5,000 or
Exactly.
whatever the amount is.
Exactly. Okay. So because we also lend money for repairs post closing on a draw basis.
So it's two loans?
It's one loan, but it's like
Just a
it's a typical construction loan, like at a bank.
Got it.
Where we advance the funds to acquire the property, and then afterwards, on a draw basis, we fund up to 70% again. So the investor who starts out with this is going to need to have some money, not only to fund the 6 months of interest, but also to get the repair started. So then they get the repair started, and once they're going in,
So
they
it's
can call
$10,000 in essence. So on this $56,000 loan, was that close? Is that the number?
So if it's an $80,000 as is, there'll be 14 of repair money, right?
Yeah, I was going to ask you how you do. Okay, before you get into that,
Sorry.
how do you? No. Finish your equation.
So we loan the 56 up front, and then the other 14 would come in post closing. On a draw basis, so we'd have a total of $70,000 in on $100,000 deal.
Okay,
so
so
no
would you
more than 70%.
Got it. Always. That's how I run my operation.
Sacrosanct.
I mean, I don't buy anything that's not 70-75. I mean, that's just me. But that $70,000, is that like what you write the loan for? But you pull back. Okay, so you write the loan for $7.
Absolutely.
Okay, great. But you're only going to divvy out the closing,
correct,
the acquisition,
correct,
and then you're going to come back later and start drawing out this with receipts or whatever.
That's right. So we go off your scope of work.
That was my question. Great job.
Yeah, you're going to give us a scope of work starting out of what you're going to do to this house, which obviously our appraiser needs to see and understand. Sometimes if you're going to add square footage, they obviously need to know that so they can give you full value for the property on an after repaired value basis. And it also tells us if you kind of know what you're doing.
Absolutely. I was just going to say, how do you determine this $20,000 repair?
Yeah.
Because Jimmy Jack's buying tile at the Habitat for Humanity.
That's true.
And then the rookie is like, I'm going to go buy $2 a square foot marble. Right. It's just not going to work on a $30,000 house.
It's totally up to the customer to make those decisions. We have contractors who do their own work, and as we do those repair draws, they're actually pocketing money, right? Because they're doing the work much cheaper, and we're fine with that. As long as the quality of work is good that's going in, we'll fund it.
So currently you have 30 houses, at one time at your height. Right now it's kind of a soft market.
Yes.
Summer's ending. Usually on your books about 60,
yeah, that's
50,
probably
60.
our high water mark.
How do you, so now, I'm approved for the loan. We write the loan up at 70. We do the 56 for the acquisition.
Yeah.
I use some of my own money because I don't want to keep drawing from you. Mm-hmm. Do you go back to the property? I'm like, I give you a scope of work. You approve it. Seems legitimate. Right. Do you go back and check this work? Because there's some sketchy guys out there.
Yeah. So let's say you do half the work and you're ready for a draw. You submit an online thing, and we send our inspector out to look at it and confirm that the work is done in a professional, workmanlike manner. And once they are,
I love that little caveat: yes. Professional, workmanlike manner.
You've seen some work. I mean, there's work and there's work.
Right. Okay. Cool.
And what we don't want to do, we don't want to. The only thing worse than rehabbing a house is rehabbing a house. And we're the ones that'll have to do that if things go bad, so we don't want to do that. So we just want to make sure it's done right. And then there is a fee. There's a $150 fee for each repair draw. So most of our customers...
Makes them think about it.
Yeah. You don't want to do one every week. Most of them do it when they're halfway done, and then we're totally done.
So how'd you learn how to create fees? I mean, I know that that's a business model for banks in general.
Yeah.
Called junk fees, and I'm just now private lending, so I kind of had the gist. I mean, is it like, that investor I talked about earlier, he charges $50 just to go look at a deal. Is that just out of headache? Is that because you're seeing a lot of flunkies out there? Because the guy's trying to draw every week and you're like running around? Because this is supposed to be a passive investment for you.
So if you...
How did you come up with that?
Because you have to charge something or they would wear you out, right? Just like initially when we have a $100 one-time fee to open the file and get the experience questions asked and that. Well, it's a one-time fee to run your credit, that sort of thing.
Just to get you going. Okay.
That's right. And then when you have a deal, it's $500 to go out and do the property analysis. So nobody's going to pay us $500 unless they know the numbers work, right?
Or they're serious.
So that is a terrific screening device for us because we don't want to waste our time with it unless it's a real deal.
Now, after you've cultivated these relationships, then it's pretty simple from there on in.
Oh, yeah.
After the track record.
When you go through it one time, we've got people who've done 30 loans with us.
Sure. And these are people that are professional flippers.
Yeah, they really are. Yeah.
Right. And they like the fast and conveniency, and they have it's just like that. Why am I so loyal to the bank that I'm loyal to? The guy knows me. I mean, I just, I do my annuals with this guy.
Yeah.
And it's like, here's your lending limit. Go to town.
That's it.
Don't call me.
That's great, but that's very unique. Most people are in the position where it's going to take the bank 45 days to tell them no. Well, the deal's long gone and dead by then.
So
right?
you have to move fast. What's a typical time frame?
Oh, 7-8 days.
So, yeah, I mean, of course, there's some due diligence in the beginning to do their $100 acquisition beginning process. Okay. Well, this just sounds just so great. All right. I mean, you're just so smiling, got your white shirt on. Tell me, you got to give me some juice here. Defaults, like inexperienced investors. I mean, you're the main guy that you're dealing with? I mean, I don't know how you're going to leverage 50 loans. I mean, I'm only playing with 2 right now.
Yeah.
And I'm like, a little nervous, like, where's the payment? I'm like, I'm assuming you have software to keep track of this jazz.
We do,
but there's got to be some risk for you in newbies and defaults. And how do you handle that? Sure. Give me some examples.
Sure. Again, the $500 fee screens out a lot of that. But once that gets started, we have to make a judgment call at some point. Can this guy pull this off or not, right? And then once we make that call, sometimes we make a mistake.
Sure.
And I would tell you about 5% of the loans get into deep trouble. We do not want the house back. I can guarantee you that. If there's anyone out there thinking that, they're just loaning me money so they can take my house.
Yeah, that's a negative because people think that.
Yes.
Predatorial.
That's right. You could design it in that way. We are not interested in that. However, we have gotten over the 10 years, we got about 19 houses in inventory.
Wow.
As a
over
result,
the time?
Over the 500 loans.
Wow.
So that's not that bad.
0.0.
Yeah, well, it's about, what is that? 0.5% or something.
Yeah, that's
But
real
we've
low.
had far more loans in trouble. So those are the ones we actually ended up with. Many loans get into trouble and they go beyond the 6 months. You do not want to be flipping houses if you're going to have this asset more than 6 months, right?
Yeah, is there a fee? How do they renew? I'm assuming you're open to renew.
I am. I honestly,
for the fee.
It's quite punitive. I mean, a lot of hard money is just charge 2 points a month or something until you get it done. Ours essentially is a 25% annualized default rate. But recall, you pay that 6 months up front. So after you get the loan going, you don't even have to talk to us for 6 months if you don't want to. And then if you are lucky enough to get it flipped in 90 days, we rebate the 3 months of interest.
Okay, cool. So there's no prepaid penalty per se.
No, absolutely not. It's totally.
So that's a little, I guess, marketing edge for you, unique selling position,
right?
Because I mean, the preconceptions of hard money, it's like almost like a pawn shop, and it is run like that in an essence. Mm-hmm. But again, I try to remind I haven't borrowed any, so I haven't And there's a gal that just actually is in trouble, and she was alarmed about this loan, and I looked at her loan, and it was 6%. This is not you. It was not a hard money, but it's not a bank loan. It's like a private lender type deal that has, it's a 5-year yielding period. I didn't even know what the hell that meant. I was like, 5-year yielding. So I had to call my financial wizard. He's like, that's prepaid penalty.
Yeah.
And it was funny. It was only 3 months off of the 5 years.
Yeah.
So it's like it matures in November.
That hurts.
But August 2019 is the yielding period. I'm like, what does that mean? Prepaid penalty.
I've also heard it referred to as yield maintenance.
Yeah, that's it. Yield maintenance.
Okay.
Yeah, you probably get a excited about these docs. I'm reading these docs. It's from a big company out of Dallas that loans a lot of money. I'll see if we can get it. Blackburn funded them in the beginning.
Okay.
And I've actually interviewed Tim Herridge. Do you know who I'm talking about?
I do know Tim.
So B2R.
I'll be darned.
And so she's in this loan, and she's a friend of mine, and she's frustrated, and things have gone awry. And I'm looking at this loan, and I'm like, it doesn't seem too bad. I mean, you got 70% or whatever out of the money. You got a $200,000 cashier's check, and now you're having some troubles, and she wants to sell them off, and she can't sell them off because it's too skinny.
Oh, that's weird.
Because the real estate investor like me, because I made an offer on them. That's how I got involved with this.
So that's kind of like the bait and switch, right? I mean, they get in what seems like cheaper, but then you've got this yield maintenance thing, which whacks you on the end. Our points are up front, and then it's totally to our advantage if you pay us off early. Why? Because we can put that money out again.
Recycle it out.
Totally.
And the fact, because that's new fees. That's new points.
Yeah.
For a lot of people, guys out there, they make money on the points. That it's pure profit and some of the junk fees. But think about it logically. When their money's tied up, it's tied up. It's not moving. And I talk to a lot of baby little investors, private lenders, and they 12 months is that's their maximum.
Yeah.
And they want to recycle it out. Great, fun. Because I'm going to make the 4 points.
Yeah.
But back to that loan, and I was reading it, and see, here's the problem that she had. See, me, I'm a long-term investor. 5 years doesn't scare me but I see she came into a position where it hurt her because of that timetable. When I teach people about funding, and I go into ARMs, 3-year, 5-year, and people get all up in arms and F the bank.
Yeah.
Well, they're hedging against it going up or down. If it goes up, they actually lose money, because if you really understand, and let's just get into this, Scott is borrowing money from a bank or some other institution at a certain rate,
right?
And you're renting it out at a certain rate, and your money is made on the arbitrage.
Precisely.
That's exactly what banks are doing too, guys. Don't think banks are friendlier than Scott's just up front. The bank is just hidden. It's called fees.
That's right.
And in 30-page document of a promissory note. So it's the same concept. It's just you're a lot more nimble and flexible to take care of the real estate investor. If you're listening to this is what you're supposed to be doing.
Right.
So I'm not advocating hard money. I have not used it. I haven't had a need for it. I'm not a flipper. In your case, that's your customer base.
Right.
Now, speaking of customer base, I mean, you're very active in the real estate community, and I'm glad that you are. And I know you contribute, and you're in deal maker sessions, and you're with iBugly Houses. How do you find these people, and how many new people come to you?
Gosh. Okay. So once my main marketing drive is I travel to Minneapolis once a month, and I attend a local RIA meeting there, and I'm a staple there. I mean, I've been there doing that for 10 years.
You support it.
Yeah.
Throw in some cash for them.
I've probably made 10 out of 12 monthly meetings for 10 years. Okay.
Wow. You remind me of somebody else. But
okay. And so
you're committed.
This guy drives a couple hundred people in the room, every month. And I'm going to say 65 of them are new faces. So a lot of newbies coming into that environment, a lot of new faces, a lot of new deals, great questions, people excited. And it's just kind of a cool
free money.
Yeah.
They're mine, free money.
So that's the main thing. And then also Google, right? People find us online all the time, and or word of mouth, of course.
So you're based here in Oklahoma City. How are you servicing those customers out there? That $500 initiation fee, or I guess construction lookout fee. I don't know. What do you call that fee?
So it is a property analysis fee.
Okay, and then somewhat boots on the ground, somebody out there, a company you use?
Right, which is two people really. There's a licensed appraiser who does a drive-by appraisal, and then there is someone who goes to the house to confirm your scope of work. To me, they're two different disciplines. I like appraisers. They're great. I think they're excellent at getting that nice big after repaired value number as it relates to compared rehab properties in that neighborhood, but I don't trust them on repairs. I think it's an entirely different discipline. So we have a different person with the construction background to go in and check your scope of work and assign a retail value of repairs, because that's what we're going to have to pay if we ever have to
and that's your So that's awesome. So that $500, is not a fee for you to just pocket it. It's a fee to cover the costs of
two different people.
And educating you. Because I know a drive-by appraisal is around $250.
That's right.
Maybe, I get a discount, so it's a little bit less, but it's at least $200. And you got some guy, you got to pay him a couple $100 to roll over there.
That's
and
exactly
he's going to spend a few hours, and then he's going to go back to his office and jump in and do a scope of work on his side because you're betting on that number.
Well, yeah, and depending on drive time, it really is a better part of half a day to do one of these.
So I think, man, I'm going to be honest. I was like, dang, these guys are sharks.
Yeah.
$200 application fee,
Yeah.
$500 scope fee. I'm like, what the F fee? I'm like, we haven't even made money. And now I realize, man, if I was a rookie, and if you're a rookie out there and you got a first great flip under contract, I would go this route.
Yeah.
What's the worst thing that can happen? Overall, maybe you not lose, but your cost of doing business is $3,000, $2,000.
Right.
But you have accountability.
Yeah.
Think about it. You can hire a coach and he's going to take your 10 G's and yell it and scream at you and tell you do it right, do it wrong. But you're giving him hard data. You're giving him a real appraisal.
Exactly.
And you're giving him real numbers. And yeah, great. If you can beat this hard numbers, that's what you should do. And me personally, I make money on construction because when I turn in my offer, I give you retail prices.
Right.
This is what it costs, $3.50 to lay ceramic tile. Now I can get it done by maybe $1.50.
Sure.
It depends on. Awesome.
Yeah, we don't care how you get it done, just as long as it's done right.
All right. So now you see these guys default. What does this look like for you personally in your real estate portfolio? I know you got back into the franchise of We Buy Ugly Houses. Good for you. What we do. No. So, are you trying to buy and hold now?
Yes.
Your dad's been in it since the 70s. So obviously, I don't know how old you are, but in the 80s was the gold mine. Yeah. Houses were $4,000, $5,000. My mentor was just had cash and he was gobbling it. So. Are you seeing?
Okay, now we were just commercial real estate investors up until 2002. Okay, so it was
not single family.
Correct. It was strip malls, warehouses, that sort of thing.
Okay.
Just as investors, we didn't even operate them. We hired Price Edwards to run everything, basically, who were great, by the way. If you're listening, Price Edwards, they're awesome.
Yeah, he just spoke not too long ago. I just saw him.
Oh, really?
Yeah.
Carl's amazing.
Yeah, it was the projection, like the corridor on 44th and Memorial. Yeah. And or Memorial, he was going all off on that deal.
He's a class act all the way. But anyway, and then we started buying houses, 2001 maybe, 2002. And then we decided, if we're going to do this, let's get the best brand out there, which we felt was Homevestors, and started buying houses. So all of our single-family residential knowledge began around 2001, 2002.
So are you holding now? Are you aggressively looking? Is that why you're in the franchise now?
Well, yes, because after getting those 19 houses back and we had in our rental fleet, we then started focusing on how to run a rental fleet as best we could, and we found a model we liked and applied that, and then we decided, okay, now we want to add to that fleet. And so I added about 15 houses last year, and I really like what it's doing. So now I said, okay, my brother called me, who runs the Homevestors franchise in town, has the same one we started in 2003, by the way.
Rich, right?
Rich, correct.
Right.
Exactly.
I've bought like 10 houses from him.
Okay.
From Billy.
Oh,
when Billy was his buyer.
Yeah.
Back in the day.
That's right.
So interesting.
And so
I never really met him. I just met Billy all the time.
I see. Okay. And then, but I've been out of that for 10 years, right? But he calls me and said, hey, there's this Homevestors franchise that is struggling and they want out. Do you want to buy it? And I said, yeah, I want to buy it. So, because I miss it. You know what it is.
You're all in, man. I get the t-shirt on.
It gets in your blood, right? You're kind of screwed, right? You're going to do this the rest of your life. You're never going to retire. So if you're listening to this and thinking about getting into it, just know that.
All right.
Isn't it true?
It's true. I'm never getting out.
Absolutely.
It's too much fun.
The type of leads that the Homevestors model creates is ideal for the type of rental fleet that I want to build. So it made total sense.
Well said. All right, let's wrap this up. It was a pleasure just getting to know you, and
I feel like we just started. It's over.
I know. Well, it got 30 minutes.
Okay.
I don't want people to shut it off. We can keep going, Daddy. You asked me when we started. You're like, how long is this going to be?
Yeah,
I'm like 30 minutes.
It's what I talk about houses all day, every day. So the time flies. I love it.
No, I think you've given enough information. Either you're in or you're out. You're going to do it or you're not, and my goal is just to introduce. There's opportunity out there. There's no reason why you can't get into real estate, right. Even if you got a do your first rehab.
Right.
And, there's a potential funding here in Oklahoma City, Chicago,
That's right.
Denver, Indianapolis,
It takes a while to figure out that it's not so much the cost of money, but the availability of money. And
I agree with that.
I've borrowed money. It paid too much too, believe me. And once you figure out that it's really coming out of that seller's pocket when you buy, you just got to buy right. That's the whole thing.
That's the trick. All right. So what advice would you give to the customer that is considering hard money? What tips would you give them?
Right.
To get their together.
Well, if they haven't done a flip at all ever before, then they just got to partner up with somebody who has. They got to have a mentor or a partner on that particular project with a guy who has before, or a girl.
And that's what you're looking for too when you're doing your due diligence.
Yeah, all we care about is somebody in the team knows what they're doing,
right,
and is motivated to see that it's done.
And
not just a consultant, but just someone who's vested.
Yeah, I mean, I'm just impressed. You've seen everything. I can't imagine. I mean, it's just from your dad, but just, I mean, I know you're in a bunch of circles. I know you've seen defaults, bad things, good things, and you're still positive about it. So the answer to the question is, get someone to be vested with you, maybe 50-50 on them. Maybe they're the player on the deal. Maybe you write the loan, in your name, but you get someone that has some equitable interest alongside of you. Anything else? How about documentation? Anything that they need to be prepared for before they even call you?
Oh, the best advice I can give is to call the office and talk to Sandy. She knows it better than I do. I'm just kind of the pretty face in this organization.
Oh, shit. What's your phone number?
So it's 512-5626.
405?
405-512-5626. Ask for Sandy, and you don't need to talk to me.
Is this for all your markets? Same phone number, 405? Okay, what's the website?
reddirtlending.com.
All right. Well, it's been a pleasure to interview you on the radio show, Scott. I can't wait to have you back. I don't know. Maybe you'll have 100 units by then.
I would hope so.
What's your goal right now? I mean, so you're spending money on We Buy Ugly Houses, so it's not cheap.
No, it's not.
So you've got to have some kind of ROI in mind. What is that, and how many units?
Well, the goal just shifted 2 days ago. I was going to go from 40 units up to 100. But I've got this investor who's approached me, and he wants to have an exclusive on all the properties I buy. So he wants a big rental fleet in Oklahoma City. So I don't know what that means yet, Stephen, but I think it's going to be a lot of freaking houses.
Isn't it great to know that you have money just ready reserve?
Well, that's right, because you can now buy with reckless abandon, right? But the point is, it is true. When you know the funding's there, it's a whole different ball game.
Yeah, you can, and I don't know. I hate to say this because I've actually overpaid a few thousand.
Oh yeah, so many times.
I just, it's a deal.
Get over it.
Yeah, it's a deal.
Get over it.
I mean, I hate to say that. The goal is to buy assets that produce income.
Yeah,
a bunch of little army men with that are dollar bills.
They're little geese laying golden eggs.
Yeah,
and we let our tenants, buy the properties if they can, which is great. And I love it if they do. If they do the work and get it done, I'm real happy for them. But the goose dies. So it's a little sad, really, but I want to build a big fleet. Yeah. So to those investors out there, also, if you're looking to sell a house, I'm not going to overpay, obviously. But if you have one to sell me, I am looking right now.
What a plug. All right, bud. It was nice to meet you, and go buy houses.
Yes, sir.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at SavvyRadioShow.com. Connect on Twitter at LandlordBook and always be buying assets.